Okay, we have done till 3 scenarios. The first scenario was non-dividend paying stock, which is spot price into e power RT. The second is dividend paying stock in terms of rupees, then it is adjusted spot price into e power RT. Third scenario was dividend in percentage, which is spot price into e power R minus y into t. The fourth and the fifth scenario is like you get an income from an asset. Share is an asset which gives you income. There are assets which will not give you income but will give you expenses. And classic example is physical gold. If somebody is holding on to a gold, there is no return which you generate out of the gold on a day-to-day basis except for the price appreciation. Like dividend income, I don't have any other income from a gold asset, but I will have a cost associated with that. So that is technically called a storage cost. So like income, you can have cost. If there are costs, what do we do if the storage income is in rupees? Income in rupees, what we do? Spot price minus present value of dividend income. If storage cost is in rupees, then it is spot price plus present value of storage cost. You will add the cost rather than deducting the income. You will add the storage cost if it is in rupees. If it's in percentage, then it is R minus Y, like that, R plus S. Instead of R minus Y, it is going to be R plus S. Same formula. If dividend is in percentage, you deduct the dividend income. If storage cost is in percentage, you add the storage cost percentage. If the dividend is in rupees, you adjust it from spot price. If storage cost is in rupees, you add it in the spot price. So that is your fourth and the fifth scenario. Okay, both the scenarios are done together. If the storage cost is expressed in rupees, adjusted spot price will be normal spot price plus present value of storage cost. If it's expressed as a percentage, e power R plus S into T. So totally 5 scenarios. One scenario, no dividend, no storage cost, which is spot price into e power RT. First adjustment comes because of dividend in rupees, then it is spot price minus present value of dividend income. Then it becomes a percentage, then it is spot price into e power R minus Y. Where you do minus Y, you will have to do plus S. Where you do minus dividend income, you will have to do plus storage cost. Clear? Any doubts on this? So these are asset classes which do not generate income, but they generate expenses. When you are, instead of physically holding gold, if you hold gold in the form of futures, you will not have this expense. So that is why there the futures will consider to be a better value. Your futures will have a very high value as compared to the spot price, because one, because of time value of money. Second, because of saving on the storage cost. There's a saving which happens on the storage cost. So let's do this. Question 5. Gold futures have been opened up in India recently. 3-month gold futures is available at 800 per gram. Suppose the current price of gold is 775. It cost 5 per gram in arrears for the 3-monthly period to store gold. What is the fair price if CCRFI is 8%? Rental is 4% instead of 5 per gram. What is the fair price? And the third part is some implicit convenience yield. I'll come to the implicit convenience yield. Let's do part 1 and part 2. In part 1, how have they given storage cost? 5 per gram in. What does 5 per gram in arrears mean? When will this 5 be paid? In month 3. It is going to be paid in month 3. Like we had a dividend income which was paid after 4 months. Here the storage cost will be paid after 3 months. You will have to bring it back to the today's date, do the adjusted spot price, then do e power RT. Let's capture the information. Spot price, what's the spot price? 775. Spot price is 775. R, how much? 8%. Please complete it. 8% per annum. 0.25 years. Beyond this, I need to check whether storage cost is there or dividend income is there. If it's in percentage, what is to be done, you know. If it's in rupees, what is to be done. So what is there in this question? Storage cost, how much? Rupees 5 in month 3. Rupees 5 in month 3 to be paid in arrears. So you'll pay it after 3 months. Rupees 5 in month 3. Now this 5 has to be brought down to today's value and you will have to add it. Clear? Any doubts on this? I think the question is said just 5. So I assume that it is 5 for the 3-month period. If it was a per month, then things become more complicated. 5 in month 1, 5 in month 2, 5 in month 3. Month 1 has to be discounted with month 1 factor. Month 2 has to be discounted with month 2 factor. Month 3 will the month 3 factor. That is e power 0.01 for something, 0.02, 0.03. It can keep changing. I assume here it is rupees 5 in month 3 only. No, so if it's every month, so if it's every month and going to be paid in month 3 is fine. If it's a monthly arrear, means normal understanding is at the end of every month you have to pay it. So then only it will be a monthly charge. So now write adjusted spot price equal to spot price plus present value of storage cost equal to spot prices 775, 5 into what? E power 0 point into, I'll show the values, you can pick it up from here. You can pick up the relevant value. When you want e power minus x value, if you do in the calculator, you will get the e power x value, and inverse of that is e power minus x. 5 into what number you will do? 0.98020. So 775 plus 5 into 0.98020. When you add all of this, what do you get? 779 point. Use this and get the fair futures price. We will use this and get the fair futures price 779.9. Any doubts in this? Now use this and get the fair futures price. Fair futures price is equal to 779.9 into e power 0.02. What is the answer? Any doubts in this? Clear? This is the fair futures price as per our calculation. Can we proceed? Now, instead of this being in rupees, they are giving now in terms of percentage, right? FFP equal to spot price into FFP equal to spot price into e power r plus s into t. E power r plus s into t. What's the spot price? Into e power r is how much? 0.08. S t is how much? 798.62. ठीक है. $798. Now, done with this, you'll have to multiply with 1.03045. Multiply with 1.03045. Okay, now listen. The spot price, I'm explaining the scenario too. Any one scenario I'll explain. Spot price was 775. Futures is how much we got? 798.60. The difference between these two is technically cost of carrying the asset for 3 months. That is why you have a difference in the spot price and the futures price, because spot price is today's price, futures price is the price after 3 months. So if you have to carry gold for 3 months, you have to spend 23 rupees 60 paise. What is this 23 rupees 60 paise? Two parts. One is for storage cost and second is for the interest part. So indirectly you will have to spend 23.60 to carry the asset. So technically it is called as cost of carrying the asset. The difference between the spot price and the futures price is technically called as cost to carry the asset. Now wait. If the futures price is 770 is to be considered fair, you have done your analysis and said that this is the fair futures price. They are not agreeing on this. They are saying the right price is 770 per gram. What is the implicit convenience yield? Now please listen. Fair futures price is equal to spot price plus cost of carry. That is, in your example, 798 was the fair futures price, spot price was 775 plus the cost of carry was 23.60. But now these guys are not agreeing on 798. They are saying what is the fair futures price? 770. That is because of an item called as convenience yield. I'll explain what is convenience yield now. Futures, does it have an expiry date? Yes, futures have an expiry date. Now people say that instead of holding on to futures, I'll hold on to physical gold. I don't want to hold on to futures. The reason for that is, if there is a huge scarcity of gold, the gold price will keep moving up. The gold price is continuously moving up. In futures, at the end of March, I have realized the gain and I have to come out of the futures contract because till March only. Whereas physical hold will give you the gain even in the month of April, May, June, July, August, because physical gold does not have an expiry date. So because of that, in times of scarcity, whenever there is a scarcity, having a physical commodity is always better than having a futures. So because of that item, what will happen is your physical gold will be considered at a premium as compared to the futures. So in futures, you said 798, they are not agreeing on 798. They say it's only 770. It's not worth 798 because there is an expiry date attached to the futures contract. If there is a scarcity of gold, if I am having physical gold, I am eligible to enjoy the gains till the gold prices are appreciating. Then I can come out. If the trend is reversing, I can try to come out. So sometimes they say there is a convenience of holding the physical commodity. That's why it is called as convenience yield. There's a convenience attached with holding physical commodity. Convenience yield will come into picture only if there's a scarcity of a product. If there's no scarcity of a product, convenience yield is always zero. So now write implicit convenience yield equal to implicit convenience yield equal to implicit convenience yield equal to FFP given in question, FFP given in question, okay, sorry, it's the other way around, computed FFP minus FFP given in the question, computed FFP minus FFP given in the question. We computed something, they are not ready to agree, they say this is the fair futures price. So the difference is implicit convenience yield. Computed FFP minus FFP given in the question. You will have two answers. Part 2 will have a different answer. Part 3, part 1 and part 2, for both there is going to be a different answer. What was the original fair futures price you computed? Point minus 770. If it is in rupees, it is 25 rupees of convenience yield, 25.65. Second part you said 98.6. Again minus 770. Basic rule is there is always a benefit of holding on to the asset, physical asset, if there is a scarcity of a product. If there is no scarcity, there is no concept of convenience yield. There is no concept of having a physical commodity and gaining out of it. Any doubts in this? Now write a formula. FFP equal to spot price plus cost of carry minus convenience yield. I'll give this equation for part 1 of the question. Cost of carry minus convenience yield. 770 equal to 775. This part 1, original part of the question. Original part, listen, you got the price as 795. Whatever price you get minus the spot price is the cost of carrying the asset. That is the cost to carry the gold for a period of 3 months. So 770 equal to 775 plus 20.65 minus 25.65. What is 20.65 is whatever you computed minus the spot price. Cost of carrying the gold 795 minus 775. 795 minus 775 is the cost of carrying the gold. But market is not ready to agree to this. Market is giving a lower price because of convenience yield. If there is no convenience yield, it would have been plus 0 or minus 0. We would have got 795 itself. spot price plus cost to carry minus convenience yield. Convenience yield will come into picture if the question is not agreeing on our futures price. We have computed something and they don't agree to it, it means there is a convenience yield. If this part was not given, the third part, then the convenience yield is 0. So most of the times this will be 0. So originally what you would have done is 795.65 is equal to 775 plus 20.65. The cost to carry is the difference between the spot price and the fair futures price. But if that fair futures price which you compute is not agreeable to the question, then there is a convenience yield coming into picture. Any doubts till now? Why convenience yield? Because when you hold on to physical inventory, you don't have a gap in between for the gains, because gold, if it becomes a scarce commodity, for 2 months only you can gain in a futures contract. But in a spot contract, you can keep gaining for any number of years till the gold becomes scarce. Clear? Let's do question number 2. Yeah. Convenience yield. So convenience yield we have already done. That's the difference between your answer was 20.65 and 25.65 and 28.60. Yeah, that's the answer. Yeah. We only have to incur. Whoever is holding on to this. Somebody else is going to incur it. So, be it whatever kind of the transaction. See, when I do my analysis, I never ask you whether you are buyer of the gold or the seller of the gold, or whether you are buyer of the share. We are valuing the gold. I'm not valuing from your perspective or valuing from my perspective. Gold as a commodity, the analysis is this way. When I come to arbitrage, I have not done arbitrage analysis in this. When you come to the steps, somebody else is going to incur it or we are going to incur it. So, like dividend is an opportunity cost. In this case, storage cost is an opportunity income. Like you have an opportunity cost, you will have an opportunity income here. Let's do question number 2. The 6-month forward price of a security is 208.18. The borrowing rate is 8% per annum payable with monthly rest. What should be the spot price? Rework, quarterly, half yearly and continuous compounding. Okay. In this question, futures price is available, but the spot prices are missing information. What is the futures price? And they have asked us to calculate the spot price. Now, please listen. They have said borrowing rate is 8% per annum payable with. So, here you are not going to do e power RT. You are going to do 1 plus R the whole power n. R in terms of monthly calculation. N in terms of monthly. Monthly rest means monthly compounding. Payable with monthly rest. There are rework which I have given for quarterly, half yearly and continuous compounding. This e power RT will work only if it's continuous compounding. Otherwise, it's into 1 plus R the whole power n. Derivatives as a principle has to be CCRFI. Institute consistency is not. This is an exam question. The first part is an exam question. What should be the spot price is an exam question where they have clearly mentioned it has to be monthly rest. At least it's clearly mentioned. So let's follow whatever they have done. Now write spot price equal to question mark. Spot price equal to question mark. Futures price equal to how much? 208.18, R equal to 8% per annum is not going to work out in this question. I'll have to mandatorily convert this per month. Tell me what is the monthly interest? 0.67 percentage per month, because the question specific requirement is monthly compounding. I don't have an option. I cannot write 8%. I'll make a mistake if I go with 8%. N equal to 6 months. N equal to 6 months. Any doubts in this? Fair futures price is equal to spot price into what? 1 plus R the whole power N. It's not into e power RT. E power RT is for continuous, into 1 plus R the whole power N. Now listen, when I was doing continuous compounding, I said R can be for any period, T can be for any period. I'm not even bothered about it. But both have to be for same period of time. When you do monthly, half yearly or quarterly compounding, if it's monthly compounding, R has to be per month. N has to be in terms of months. If it's quarterly, R has to be per quarter, N has to be number of quarters. That consistency you will have to ensure here. Now do this and tell me the answer. One plus 1 plus 0.67 percentage power 6. This is the number 200.04. Some up down can be there because of your rounding of issues. Broadly this will be the number. It is 1 plus 0.0066 in your calculator. 0.66 percentage is 0.0066 or 0067, whatever. 200.04. Any doubts on this? Now in the rework, what they mentioned. Next is quarterly compounding. Give the heading quarterly compounding. Quarterly compounding. Let's capture the information again. Futures price is how much? 208.18. Spot question mark. Futures is 208.18. Any doubts in the earlier calculation? Everyone getting the number? Anybody has any doubts in that? It is 0.00666. You'll have to add that in the calculator and into, you'll have to do 6 times and get the figure. Spot is question mark. R is how much? 8% per annum OR. 2% per quarter. 8% per annum OR. 2% per quarter. N is 6 months OR. I don't want in terms of months. R 2 quarters. 6 months are 2 quarters. Quarterly compounding means I want the quarterly information. 6 months are 2 quarters. A slight variation in the answer. You may not see a major variation. 200.096. Earlier was 044. may see a slight variation in the answer. Next is half yearly compounding. Again end up capturing the same thing. R will not be 8% or 2%. Now R is 8% per annum OR, 4% per half year, N equal to 6 months OR, 1 half year. N is equal to 6 months or 1 half year. 8% per annum or 4% per half year, 6 months or 1 half year. And the last part is on continuous. Continuous you'll have to do e power RT values. There it doesn't matter. R is per month, per year. Both have to be only for the same period of time. Obviously, I'll just come to it. Just first let's complete this. Spot price. In fact, that will be the lowest. As we increase the compounding frequency, the future value is same. When I increase the compounding frequency, when I say increase the compounding frequency, from half yearly you move to quarterly, from quarterly you move to monthly, from monthly you move to continuous, the price will keep coming lower. The reason why the price is lower is, as you increase the compounding frequency, the worth of the cash flow keeps coming down, because it remains same 208. The price have not changed. So in future, if you are getting 208 and your price keeps fluctuating, your compounding frequency keeps fluctuating, the price will keep coming down. So the best is having a continuous compounding which has the lowest value. The lowest value is because that gives you a very the expectation in a continuous compounding is very high. Indirectly you are discounting at a higher rate. Continuous means discounting at the highest rate. Monthly is lower, quarterly is lower than that, half yearly is the lowest rate of discounting. indirectly what we do is we have been doing this only, dividing it by different rates. I've not divided everything by 4%. When it is half yearly, we have divided by 4%. When it's quarterly, you have divided by 4.04%. When it is monthly, you have divided by 4.067%. Continuous, you have divided by 4.081%. Those are the effective rates. The effective rates, when you divide by a higher rate, obviously the value will keep coming down. Go through question 6. Go through 6. Okay. The spot price is available. This question talks about the practical issues which you will have. When you do e power RT spot price into everything is perfectly fine, but the problem is we never consider an item like this. There is always a transaction cost associated with buying and selling. So whatever arbitrage gain you are making, that can get lost because of these transaction costs. The second bigger issue is interest rates are never same for lending and borrowing, because until now whatever I did, I said create a deposit at 12%, borrow money also at 12%. Practically both are not going to be same. So in this question they have said define the no arbitrage boundary for a futures contract expiring in 1 year. I want to know what is the no arbitrage boundary. There can be a single price like a fair futures price, which used to be spot price into e power RT. That's not going to work out. Now my arbitrage can happen in two ways. In one way is I sell the gold today. When I sell the gold today, I get some price. After selling the gold, I'll create a deposit. This deposit will mature to some value. After getting that value, I will again buy back the gold. If the gold maturity, the fixed deposit maturity is at 35,000 and futures price is 33,000, I can still have an arbitrage possibility. I'm again explaining you. You sell the gold, you got some money, created a deposit. The maturity of the deposit is 35,000. You want to now buy the gold in the futures market. In the futures market, it was 37,000 on day 0. You cannot have any arbitrage because your deposit matures to only 35. Gold is available at 37. All this is known on day 0. If it's available at 37, you cannot have arbitrage. But if it's below 35, then there's a possibility of an arbitrage coming in, because if you can buy back the gold again. This is one scenario. The second scenario is, like selling gold, you may buy the gold. If you are buying the gold on day 0, you will buy gold by what? Doing what? By borrowing. So I'm going to explain this now in a no arbitrage boundary calculation. Now write calculation of no arbitrage boundary. Calculation of no arbitrage boundary. Split it into two. Sell spot, buy spot. Sell spot and buy spot. Either you sell the gold in the spot market. When you sell the gold, you create a fixed deposit. When you buy the gold, you take a bank loan. These are the two possibilities. So either you sell gold or buy gold. We'll have to do the calculation for both the scenarios. Now let's focus on the sell gold. Point number 1, sale value of gold. Read it and let me know how much will you get by selling the gold. If you sell it today, what will you get by selling gold? You will not get 30,000. There is a transaction cost given 29,100. If I am buying gold, I have to pay extra 3%. If I am selling gold, I have to spend 3%. That is how it will work. So I can sell gold for 29,100. After selling gold, what will I do? Deposit. At what rate can you create the deposit? At 6%. Maturity value. You created a deposit at 6%. We are not doing the detailed arbitrage steps and all. We are trying to calculate because I don't even know the price. Futures price is something which I don't know, and I cannot use any formula which says spot price into e power RT, because I have two numbers. On top of that, there is a transaction cost. All of this cannot come in the formula. Transaction cost cannot come in our formula. So we'll have to do something called as a trial and error analysis. That's what we are doing now. What will be the maturity value of this after 1 year? How much? 30,000. If I sell gold, I will get 30,846 after 1 year. If I sell gold, I'll get 30,846 after 1 year. Today I get it, but I create a deposit. Indirectly, I get 30,846. Buy spot. Point number 1. Purchase price of gold. How much? 3,900. This 3,900 would have come out of what? Loan at what rate? Basically, first step is take loan and second step is buying the gold. So take loan at 10%. Take loan at 10%. Maturity value. 33. Now my no arbitrage boundary, write this and then I explain it. No arbitrage boundary equal to 3846 hyphen 33990. No arbitrage boundary, I'll explain it. 3846 minus 33990. 30846 hyphen 33990. Now what does this mean is, if the price is anywhere in between today, you cannot have any arbitrage. The price has to be either below 3846 or above 33990. Let's assume the price is 31,000. Just imaginary scenario, listen for some time. If it's 31,000, assume you have done this strategy. Selling the gold, you have done all this, you got this money. You go to the market and now buy the gold, you'll have to buy at 31,000 because that's the rate agreed on. If you buy at 31,000, you don't make any money because your deposit was only 3846, and if you buy at 31,000, you will have a loss scenario. Okay, instead of doing this, you do this strategy. In this strategy, you can sell the gold now because in the futures you can, because you have bought in the spot. At what price you will sell? 31,000. The rate was 31,000. Day 0, the rate was 31,000, which means you can buy the gold or sell the gold at 31,000 after 1 year. After 1 year. In strategy 1, if you have sold in the spot market, you are going to buy at 31,000. If you buy at 31,000, you can't make any money because your deposit was maturing only to 3846. Okay, you tried doing this strategy. In this strategy, you can sell your gold at 31,000, but still you will not make money because you have to repay to the bank how much? 33,990. In both the cases, you will not make money. You will lose money only. When can I make money? If the price was below 3846 on day 0. On day 0, if the price was something like 30,000, then I get into an arbitrage scenario. That is a great scenario for me to work with, because if the price is 30,000, what will I do is, I'll do all of this. Step 1, step 2, step 3, all this is done. Now buy the gold at 30,000 and earn 846. Buy the gold at 30,000 and earn 846. Any doubts on this? Able to understand this? Clear, not clear? Similarly, if this was the strategy, what will happen is, if the price is anywhere above 33,990, if the price is 35,000, I can have an arbitrage. Either lower than 3846 or greater than 33,990, anywhere in between is called as no arbitrage boundary. You cannot make any arbitrage in this price. Anything above or anything below is perfectly fine. If the price, this we did when we were doing interest rate parity theory, we did something called as rates which are when you have borrowing rates as well as deposit rates, or when you have transaction costs. When we did that kind of a scenario, bid rate, ask rate being there, or borrowing rate and deposit rate being there, we did not use the IRPT formula. We did something called as a trial and error. Borrow in rupees, borrow in euros. Both the cases we got rejected. There's a possibility. High possibility practically this will happen, and you will not get an arbitrage so easily. Arbitrage is extremely difficult in a practical world to spot. The moment it is spotted, what people end up doing is they take a huge position. So the moment if people find the gold is at 30,000, they'll enter into a transaction. Because of that transaction, the price 30 will automatically go up to 31, 32. The price will again shift back to the no arbitrage boundary, but I've already made my money because I've already entered into an arbitrage. In practical world, the moment an arbitrage is spotted, people may enter into transaction even worth 100 crores, 500 crores, because the gain is very insignificant, but the amount which you invest is huge, so that you make money. So you will make that money and then keep quiet. Similarly, again you spot it, again you enter into a transaction. Practically it's called as algo trading, algorithmic trading. So the algos will predict if at all there's an arbitrage coming in. When algos predict it, when algos see it, automatically the transaction is entered in. So that is how systems are built, which will ensure that the transaction is entered immediately. Clear? Now you have done till this no arbitrage boundary. Next, the second part is rework. If on short sell, the trader can receive a fraction amount of 80% from the broker. Now whatever I said, no sell gold, buy gold, will work only if I have gold in hand. If I have gold in hand, I can sell it. Buy gold anyway can be done. I need not I don't require a physical gold. Now short sell means you are selling the gold, but you don't have the gold with yourself. You are selling the gold, but gold is not there. That is technically called as short sell. A short sell refers to a transaction wherein a sale is done today, but delivery will be done a year later, or 6 months later, 3 months later, 2 months later. Now the question is saying you can do a short sell, but in short sell what amount you will receive? Only 80%. When will I receive balance 20% is after I deliver the gold. After I deliver the gold, he will give me the balance 20%. So let's do this. Next, short sell scenario. Short sell scenario. Again, sell spot, buy spot. Buy spot, you copy paste the same thing. Sell spot, buy spot. Buy spot, you copy paste the same thing. Exactly the same thing. Short sell has no impact there. Short sell basically refers to a transaction wherein you sell the commodity, share, gold, everything, but you don't deliver it. Practically you also receive money for it. That's how contracts are negotiated. You will also receive the money, but in this case they said you will receive what? Only 80%. Now listen, this side sale value of gold is into 0.8, 29,100 into 0.8. You will not receive the entire amount. 29,100 into 0.8. How much? 23. When will you receive the balance amount is after 1 year. You will receive the balance amount. It's not that you are not going to receive, but that money will come after a year. Now the only difference is, because of this, you will earn interest only on 23,280. You will not earn interest on 29,100. Next, point number 2, create deposit at 6%. Now listen for a minute. Maturity value is 23,280 plus 6% interest plus the difference between these two. What is the difference? 29,100 and 23,280. 58. You will receive your 5820, but that will come after a year. You will receive the money. The pitfall is interest is lost. In fact, the arbitrage boundary will further shrink now. It will further come down. 23,280 plus 6% plus 5820. You can write down the no arbitrage boundary. Complete this. With that, I'll end today's session. I'll continue in the next class then.